Most traders quit before year 3. It took me 4 years just to become profitable trading futures and another 2 to actually make real money. I have spent more than 12,000 hours analyzing and trading futures and stocks. I have tested indicators, systems, strategies, algorithms, and in the end, I have removed almost all of them. The only thing I use today is pure price action. I'm also the author of the book What Professional Traders Really Use, where I break down the methodology professional traders rely on, without indicators, without shortcuts, and without magic signals, just using price. In this channel, I will show you what works and what doesn't, and what kind of information you really need in order to be profitable in these markets. Let me be clear about something very important. If you need constant excitement, adrenaline, or dopamine hits, this isn't for you. Trading is slow, it is repetitive, and sometimes it can even be a little bit boring. If you are looking for entertainment, you shouldn't begin with trading, and you should probably find another hobby. But if you are willing to think long term and treat this like a profession, you are in the right place. Most traders are looking for the perfect indicator or the perfect candlestick pattern, and they learn lots of candlestick patterns and probabilities and so on. But after more than 12,000 hours in the markets, I can tell you this. High probability trades don't come from shortcuts. They come from understanding market structure, liquidity, and participation. Today, I will show you the 6 precise steps I use every day to define exact entries, long and short, and the most precise exits. So no magic tricks, no random patterns, just pure price action logic. The first thing I analyze is the market structure. Before I even think about entering a trade, I need to know some things. Are we trending? Are we in a range? Are we compressing? Is there expansion or contraction? I see many traders rushing into trades without even knowing what kind of structure they are trading in. They see 2 or 3 candles forming a pattern and they jump in. And when you watch short videos online explaining magic strategies based on 2 candles or one setup which works best without taking into consideration what kind of market structure we had, I can tell you something very clearly. This is not going to work consistently. Trading is more complex than that. You probably know that, and you have to accept that. You can learn it, absolutely, but it's not just about memorizing candlesticks or patterns or magic things. And I did the same mistake at the beginning. So this is a typical thing. Don't worry about that. But now you have to change that because otherwise you're not going to move forward. Context changes everything. So without structure, every setup looks valid. That's the problem. And with structure, you can filter them. Structure tells me whether I should focus on longs, shorts, or simply wait. The second step, you probably know already, is identifying the most important resistance and support levels. And when I say the most important, I will explain you what it is. I see every day many traders just finding horizontal lines everywhere in their charts. And this is not going to help you at all. Everything is a resistance and support level for them. This is not going to work. What you should focus on are the following things: previous session highs and lows, supply and demand zones, imbalances, breakouts, and failed breakout zones. Actually, this last one is my favorite one. I want to know where real decisions were made before, because the market has a kind of memory and many things repeat. Because if some areas or some price intervals matter, they will repeat. For instance, ranges, where you see a range, where you see a price moving back and forth in a price interval, this price interval is probably going to happen in the future as well again. The third step is very important. Do you know exactly where the biggest volumes are? Just to know where big volumes are located, because it means that big participants of the market are trading at those areas. And to recognize those areas is the most important thing you can do in order to define your trades and in order to look for further confirmations in order to trade. So I look for high volume nodes. I look for areas of acceptance and areas where price left aggressively. So where price reacted aggressively. When the market moves strongly away from a level, that level is important. Big players leave kind of signals, and these are the signals you can use. When you see big candles closing strong without a wick, those are important signals. The question is now where they appear, and you can generate a strategy around that, as I will explain in the next videos. Pay attention for those details, for what indicates that bigger participants are active. The fourth step is you have to identify liquidity. And how do you do that? I will explain you it right now. Liquidity is where stops are resting, above equal highs, below equal lows, above obvious resistance, below obvious support. The market consistently seeks liquidity because large orders need counterparties. Many traders enter before liquidity is taken. That's really dangerous. Professionals often wait for liquidity to be taken first, and best entries come after that, which means after traps. And if you want to know what's a trap, you can check on this video I just did some days ago. The fifth step is one of my favorite ones because I always criticize people using a lot of candlestick patterns because I was one of them. I learned all of them. I had a spreadsheet with all probabilities I found somewhere, but I can tell you, you just need two different candlestick patterns, engulfing patterns and pinback candles. You have to understand what they mean, always using previous candles as a reference. A medium-sized pinback candle is not the same as a big one or as a smaller one, depending on what type of candles you had before. So please concentrate on two candlestick patterns, pin bars and engulfing candles, and that's all. That's all you need. I will come back to the subject candlestick patterns at some point in one video in the future. Location is more important than the candlestick pattern. The perfect setup in the wrong place is still a very, very bad trade. So the setup of your trade, the position, is the most important thing. After that, you look for the right signal, the right candlestick pattern if you like, but only then, only after that. This is very important. You have to be precise. You have to recognize very quickly. You have to see very quickly if this is the pattern, if this is the situation, if this is the context. And there is a way to do that, a very structured way to do that, which I also explain in my book, what professional traders really use. And it's even more important in faster markets like futures and some stocks which move quite fast. Step number 6 is don't use indicators. If you use indicators, just do that for confirmation. But there is one thing I have to tell you. There is one indicator which I like. I don't use it to define entries and exits, but I like it to have a kind of reference of the strength of the movement. If the momentum is a good momentum, if there is an uptrend or not, if there is a range or not. And this is the exponential moving average. You can use the exponential moving average in order to gain more information about the structure of the market, not in order to define entries and exits. That's the difference. You just use the exponential moving average in order to know the structure. So my framework is very simple. You need the discipline to do that. And it's structure, levels, volume, liquidity, execution, and momentum confirmation using the exponential moving average. If you apply this method consistently with precision and without cutting corners, achieving winning percentages of more than 60 and 70% is possible. And this is not magic, it's just because you understand the context and you are aligned with the bigger participants in the market. And psychologically, it changes everything. When your win rate is structurally solid, You avoid emotional meltdowns. You avoid revenge trading. You avoid losing confidence after 2 or 3 losses, and you stay stable. And in trading, emotional stability is one of the most important things. So if you want to go this path, there is only one thing you can do. You have to learn how to understand the structure of the market. You need discipline in order to repeat these steps over and over again. And you need a very precise execution, just knowing which entry signals are the right ones. I'm recording my trades almost every day. I also do sometimes market analysis only for the S&P 500 mini, which is the financial instrument I like most. And if you wanna check on those examples, I think it will be important for you in order to understand how this process looks like. As you can see, when I'm recording these trading sessions, they are not fancy, so these videos are just plain. I'm not doing a lot of editing in order to increase your dopamine or something. You will see, you just have to be rational. You just have to stay very, very quiet, very relaxed. And if you see them, they are long videos, sometimes 25, 30 minutes, but you can rewind them or increase the speed of the video if it's too slow for you. But trading is slow, and you will see this is actually the reality of a professional trader, just to look at charts 1, 2 hours, being patient, doing things relaxed. And if nothing appears, you just wait, as if you were fishing and you don't see the right conditions in order to get your fish. So it's the same thing. Take a look at some of these videos here, and if it's interesting for you, just subscribe. I will upload more similar videos. So thank you very much, and see you next time.